Picture this, you pay for income protection insurance every month, quietly, in the background, and you've never once thought of it as something you can claim. If that's you, you're in very good company. In e-tax analysis, only 2% of Australian taxpayers claimed a deduction for income protection premiums, even though the ATO explicitly allows it. And if you didn't know that, it's genuinely not your fault. Nobody sends you a reminder, so today I'm going to walk you through exactly how to check your cover, how to claim the deduction, and how to make sure your protection is actually structured the right way. Let's get into it. Here's the number that should stop you scrolling. According to e-tax, just 2% of Australian taxpayers claimed a tax deduction for their income protection premiums, and yet the ATO says clearly you can claim the cost of any premiums you paid for insurance against the loss of your income. So why do 98% of people never claim it? Usually one of two reasons: you don't know it exists, or your cover is structured in a way that quietly kills the deduction. Both are completely fixable, and I'll show you how to tell which one applies to you in a moment. Before the steps, let me show you why this actually matters to your wallet. Let's run it 3 ways. If you're on the lower end, say a $900 annual premium at a 34.5% marginal rate, which is the ATO bracket for $45,001 to $135,000, that deduction is worth about $301 a year. In the middle, at $1,200, it's worth around $414, and if you're paying closer to $1,800 for stronger cover, you're looking at about $621 a year back in your pocket. Those are my assumed premiums, not regulator figures. But take the middle case. Over 20 years of never claiming, that's roughly $8,180 in avoidable tax. And here's the part most people miss. If your cover is inside super, you might be missing it entirely. Let me show you how to check. Move 1. Find out where your cover lives, because this is the single biggest factor. Log into your Superfund online account, usually through MyGov linked to your fund, and open your latest statement. Look under the insurance section for anything labeled income protection or salary continuance. Write down the policy type and the annual premium being deducted, then check your own bank account for any insurance premiums coming out directly. The key question is simple: are the premiums coming out of your super contributions or out of your own pocket? That one detail decides whether you can claim a deduction at all. And here's where it gets genuinely interesting. The answer surprises most people. Here's the rule to burn into your memory. The ATO states it plainly: you can't claim a deduction if the policy is through your superannuation fund and the premiums are deducted from your contributions. e-tax says exactly the same thing. You can get a tax deduction for income protection as long as it's not arranged as part of your superannuation. So if your only cover is the default policy inside your super fund, your personal deduction is 0. Now, I want to be upfront with you. That isn't automatically the wrong choice. There are real reasons people hold cover inside super, but you should be choosing it deliberately, with eyes open, not stumbling into it by accident. Big difference. Move 2. Work out exactly what you can claim. Grab your latest income protection policy schedule or annual statement. If your cover is bundled with life or TPD, this matters a lot, and it's where people trip up. Suncorp explains that if only $250 of a $1,000 bundled premium relates to income protection, only that $250 portion is tax deductible, so you can't just claim the whole bundle. That's a mistake I'll come back to. Find the income protection only portion, then add up everything you paid across the financial year. That's your monthly premium times 12 or whatever your statement shows. That total is the number you'll enter. Now to actually claim it, and this part is easier than you'd expect. In My Tax, go to the deductions section and open other deductions. The ATO My Tax instructions explicitly say you can claim the cost of any premiums you paid for insurance against the loss of your income. Enter your total income protection only premiums there, labeled clearly as income protection insurance premiums. That's it. If you're at that 34.5% marginal rate paying $1,200, this single entry brings your effective out-of-pocket costs down to about $786, with the rest funded through reduced tax based on ATO rates. Getting this right looks like that entry appearing every single year. Getting it wrong looks like paying premiums from your bank account with nothing under other deductions, money you simply hand back. Move 3. Decide whether restructuring is worth it. Start by reading the MoneySmart income protection page to understand benefit levels, which MoneySmart says typically run between 75% and 90% of pre-tax income. Then ask your super fund for your current policy wording and premium and get a quote for comparable standalone cover from a licensed insurer. Same waiting period, same benefit period. Compare 3 things. The premium inside super with no deduction, the standalone premium outside super which is generally deductible per the ATO, and the actual benefit definitions. If the standalone policy gives you better after-tax protection, apply for it first. And only cancel your super cover once the new policy is locked in and active. Never leave yourself with a gap. Here's something almost everyone gets wrong, and it's a big one. You might assume income protection benefits are tax-free. They're not. The ATO says if you receive a payment to replace salary and wages, you have to include it in your tax return. E-Tax and MoneySmart note these policies typically pay around 75% of your pre-tax income. So if you earn $90,000, a typical benefit is around $67,500 a year, but at a 34.5% marginal rate, you could pay roughly $23,287 in tax on it, netting about $13 modeled using the published ATO rate. So your 75% replacement is really much closer to half your gross salary once tax comes out. Keep that in mind when you think about how much cover you actually need. The most common mistake after not claiming at all is overclaiming on a bundled policy, so let me walk you through a real feeling example. Say you're like Sarah, a 37-year-old marketing manager. She gets a bundled retail quote at $1,500 a year with only $500 attributed to income protection and $1,000 to life and TPD, a typical structure Suncorp describes. At a 39% marginal rate, she can only deduct about $195. That's 39% of the $500 income protection portion, not 39% of the full $1,500. If she claimed the whole bundle, she'd be filing an incorrect return, and that's the kind of thing the ATO does notice. So always check the breakdown and claim exactly the right amount, not a dollar more. Let me put it all together with Sarah, because the numbers really land here. If she keeps her cover inside super at $800 a year for 28 years, she misses a deduction worth about $312 annually at her 39% rate. That's roughly $8,736 in extra tax over her career. Then, if she has a 3-year disability claim on a 75% benefit of $82,500, she pays around $32,175 in tax each of those years, based on ATO rates. Combined, the modeled hit is around $105,000 compared to a properly structured standalone policy outside super. And I want to be straight with you, that $105,000 figure is a modeled scenario using ATO rates and E-Tax and MoneySmart benefit structures, not a regulator projection. Your own number will differ, but the direction is absolutely real. One more thing to flag so you don't get caught out. Some industry advisory content referencing ATO practice has cited a $3,000 per year limit on deductible income protection premiums as of the 2022 financial year. Now, that's not a formally codified ATO threshold, and it may have been revised, so don't treat it as gospel. But if your premiums are on the high side, it's worth confirming for the year you're lodging. And remember, marginal tax brackets and the Medicare levy can shift with future federal budgets. So always recheck the current ATO income protection and My Tax other deductions pages before you file. Let's recap fast so you leave with a plan. Move 1. Log into your super and find out whether your income protection is inside super or paid personally. Move 2. Isolate the income protection only portion of your premium, then enter it in My Tax under other deductions. Move 3. Compare your super cover against a standalone quote with matching terms and restructure if the after-tax maths wins. And never forget, only personally paid premiums are deductible, and any benefit you receive is taxable income. Get those 3 right and you stop quietly handing money back every single year. If you've made it this far, you now know something 98% of Australian taxpayers don't. And your one job today is to log into your super and check where your cover actually sits. It takes about 10 minutes. If you want to go deeper, next up I'm covering how to structure your super contributions to cut your tax before June 30th. It pairs perfectly with this. Just remember, this video contains general financial information only and is not tax advice. Tax obligations vary by individual circumstances. Always consult a registered tax agent or the ATO before lodging your return. I'm Sophie. I'll see you in the next one.